Dominic, what are your market predictions for 2025? This is a conversation I typically hear from clients, not the ones who are working for a longer period of time, but generally speaking, clients always ask at the start of the year what our predictions are for the year ahead. This morning, I'll be joined by Andere Casanova, our senior financial advisor, who also sits on our investment committee and is part of our portfolio construction team. So, Andere, I'm going to be throwing some questions over to you for you to be giving our listeners and viewers a bit of understanding of our ethos with the markets and how we put our portfolios together. So first of all, Andere, whilst we cannot predict the markets and we don't know where they're going to go, what are the key things in the agenda for 2025 which are interesting and of note?
Mm-hmm. Well, as you said, our investment strategy is long-term, right? So we are not active managers. We are not taking tactical positions, right? Every time there is a move in the markets. However, we are looking out and we are very well informed of what's going on. And now there are three main things that we are looking out for. Obviously, the first one is Trump. Yeah, this is in the news today for obvious reasons. This is the inauguration, right? So Trump is going to be a theme in itself for 2025. So yeah. So then obviously we all have our own views on him personally, right? But what we've seen so far is that markets like him. Anyway, so then we will go into more detail later. Second, obviously, is the Magnificent Seven, right? Which is basically your tech companies in the S&P 500 and artificial intelligence. How is that evolving? We are undercurrent is a transformation, but we cannot still understand it because these things we will only be able to understand in hindsight, right? Because right now it's happening, so we don't know yet how to even analyze it, but we are looking at those as well. And then the capital markets, basically, financing your debt, your fixed income markets. Sovereign debt, governments, risk attitude towards sovereign debt, and the term, the risk premium that the investors are asking to the governments, to finance those huge debts that are getting at record heights. Those are the big three themes, for us that we are looking at. But again, as I said in the beginning, our investment strategy, it's simple and straightforward, and we have in the investment committee, the governance process is that we don't take tactical moves, right? And anything must be substantiated by our investment strategy, that underpin any position that we take in the market. And that investment strategy, so what it is? Well, so we replicate the global diversified portfolio. That this has been, there is ample, Nobel Prizes in economics saying that this is, where in the long run, you're getting the best risk-adjusted returns, right? So the level of return is higher adjusted to your level of risk, is a global diversified portfolio. So,
interestingly,
yeah.
Sorry, I was going to say, I obviously already know the answer, but just for our viewers, depending upon where a client is based in the world, how might their geographical split be different? So, for example, a UK resident client invested in a SIP or a European resident client invested in a SIP, would they have the same level of exposure to the US and the UK, or would things differ slightly?
See, this is the global diversified portfolio is one, It's funny because in economics, right? So there are multiples, millions of possibilities, but normally one or two, there is at a given moment of time, there is just one that is the good answer, right? And in mathematics, right, that is the global diversified portfolio, regardless where you're sitting in the UK, in Italy, in China, and so on. Now, having said that, if you are digressing, right, or if you are not converging towards the global diversified portfolio, is maybe because you have home bias, for instance. And this is what we see here in the UK, in other UK pension funds, that they have higher allocations to UK assets because we are in the UK, right? And currency implications or other, considerations, there is home bias, and we know this is there is literature on it as well, talking about home bias. Or maybe some clients in the US, they also have more exposure to US assets. But in the long run, the global diversified portfolio is the one that is achieving the highest level of returns for a given level of risk. So this is what we are trying to move towards, right? So our portfolios is the same for a UK client or a US client. I mean, only maybe in certain cases, for US clients, we may need to tilt towards US a bit more, but this is one or two clients. I mean, we normally don't, we stick to our investment, the global diversified portfolio, and the same allocations, our model of portfolios for all the clients. Mm-hmm.
Yeah, it's interesting, and obviously I don't give as much advice anymore these days, but one thing clients often say things like, say you're comparing two different solutions or platforms or providers, say, oh, what's the growth rate of XYZ name company SIP compared to the XYZ growth in the QROPS? And I'm like, no, it doesn't work like that. It's actually the same underlying portfolio. It's the same performance, same cost, same everything. Actually, I had a client, I don't speak to many clients anymore, but I had a referral the other day for a lady in Hong Kong that I was working with. When I reviewed her interactive investors portfolio, which she had in America, it was 49% weighted to the UK. Now, if you're being generous, you could say the UK has a 3% allocation to the global stock market. I think it's 2 point something. When I highlighted this to her, she said, yeah, but a friend has told me that the UK is undervalued. To which I'm thinking, okay, even if the UK was undervalued, if you hold 6% weighting to the UK, you would be doubly exposed to the UK. Holding 50% for me is just unfathomable in comparison to having a global diversified portfolio. And you're correct, Andere, the number of UK pension asset clients that we have come through and their UK pension providers are so biased in the home market for UK-based funds of UK-based companies as opposed to being globally diversified. Andere, I'd like to pick up first of all, I know you had 3 points. I'd like to pick up first of all on the AI. So us as a firm here at Cameron James, we're relatively, modern, whatever you want to call it. We use AI a lot as a company and we're trying to explore it and understand it more. What impact do you think AI is having on the stock markets and volatility, etc.?
Yeah, so what we are seeing obviously is the PE ratios, right, for the Magnificent Seven. So your technology companies, they are huge, they are record highs. So we've seen, and you can see our portfolios, I think 50% of the equities is still towards technology. So the returns that we've seen in the past year, they'll be phenomenal. The clients are super happy, right? And this is mainly driven as well by the push in AI. And what it means is that there are other companies, that they're buying from this, from the suppliers, that they're trying to build up stock because of this artificial intelligence revolution that is coming. Now, the extent of it and the pace of it, it's coming, but the extent and the pace is what it is unclear. It's always time. We know it's coming, but it's time, and this is the speed and the rate, where this is going to happen. So what can happen is two things basically. One is that maybe some of these companies, they're going to miss earnings. Investors, they're going to get a bit, anxious, and there's gonna be a lot of noise in the markets starting to say, okay, look, these companies, they're really overvalued. Nvidia, this PE is not normal. And then so they're going to start questioning these things, if this is really taking up right now, and this is going to take longer, right? If we see some of the earnings missed, or it can still keep on growing because there is momentum, and then these companies will keep on, growing in value. I mean, look, I think the growth rate is going to decelerate. In my opinion, right? This is because it's been growing so much already because the base was so low. And this is always what happens. If you're growing from a small base, then the rate is going to be higher in the beginning. And then, it's like there is, so you cannot grow as much, right? From a higher base. So there's still going to be growth, maybe at a smaller rates during 2025. And then what's going to happen, as I said, is we don't know because we don't understand still. It's something that is a transformation that is going on. But the extent of it and the piece, we're gonna only be able to explain it in hindsight, right? Not right now that we are in the middle, but still, we have like exposure to those companies for sure, even if it is, the values are high. So that's in regarding artificial intelligence. Yes. Mm-hmm.
So then back to your first point then, Trump and the Trump bump. I think even all my clients are familiar with that term, or they mentioned it when looking at their portfolios. And just a quick side note on that, and when I'm doing my annual forward planning meetings with my clients, and there's been fantastic growth, I almost kind of actually use it as an opportunity to say to my clients, but just remember, if this had been a bad year, 1 out of 4 years are typically bad, it wouldn't be an XYZ profit, it would be an XYZ loss. And remember that, because in a year's time, 2 years' time, 5 years' time, 10 years' time, whenever it's going to be, remember that, Mr. Client, because, it's not just good times. So we always try to rein our clients back in and explain to them. And sometimes I even say to my clients, when their portfolio is up 20, 30%, I directly say to them, look, it could be tomorrow, next week, next month. You could have a 30% loss, COVID round 2, whatever it is that triggers the markets, and you could go back to zero. But as historically as you've seen, markets will typically recover again quite quickly. Sorry, I digressed a little bit. So Andere, in terms of Trump and Trump bump, it's a very topical topic with clients. As I say, whether you like him, hate him, loathe him, whatever, it's here and people are talking about it. How would you say, though, when you kind of zoom out over the long run and looking at the S&P 500, what effect do you think Trump would have had long term on the S&P 500 when we kind of zoom out and look at like 10, 20, 30, 40-year growth?
So what the markets are thinking, there are like two possible scenarios. We can have like a market-friendly Trump or a not market-friendly Trump, right? So market-friendly Trump will be, someone reducing, taxes and reducing regulation, and this is good for growth and for risky assets, right? And then we have the non-market friendly Trump, which will be, he's going to cut taxes, yes, but then he's going to impose tariffs. And this is what everybody, is worried about, this tariffs element. And tariffs, obviously what tariffs do, they increase inflation, because obviously the products in the US, they're more expensive now. And this has also an impact in currency, in the US dollar, right? So typically it gets stronger. However, Trump is pro devaluation of the dollar because he wants to promote manufacturing in the US, like making America great again, right? This famous logo. So he's going to need to play. It's not an easy, but this is a problem with this guy, that he throws things that they go counter, direction, and that he doesn't care. But tariffs will imply like a stronger dollar that he doesn't want. So we'll see what he does there. Whatever happens with him, I think the markets, they like him. What we saw in November, because, I'm taking this all the time, right? So in November, when he won the elections, right, I was devastated, but the markets were happy. And our clients, I remember clients where I invested the money just before. I said, okay, look, let's see what happens. Let's do maybe 50-50 before and after. So they recover fees for the entire year, just in 1 week, with the rally, the way the markets rally after he won, right? Then what we saw, and a bit also to give you a bit of an update on what's going on in the markets since, the election day. Then in December, and this is something people don't talk or don't think about too much, and it was my third point, the capital markets, is the Fed in the US. They're still there, So Trump makes a lot of noise, but the Fed is there silently, pulling the strings. And the Fed, you remember the 18th of December, they dropped rates, but not as much as they expected, because there is a sticky inflation, still core service inflation in the US. And this is a problem now in the capital markets. And we've seen in the US, the 10-year US bond, going up a lot. And well, what's the situation right in the UK with the gilts rates, because of the fiscal policies of the current government. And well, we are not going to get in there, right? But there is a lot of problems here in the UK in the bond market. So we need to look also we need to think as well, not only about Trump, but inflation, and the US Federal, the Reserve, see what they're doing. That was my third point, what's happening on the bonds side of things, on the debt side of things. For us, Cameron James, we have, our portfolios are, heavily tilted towards equity. We are risk on. Yeah, we have bonds to act as a buffer, right? When there is, because we don't want big drawdowns. However, what we've seen as well in January, bonds are great as a buffer because they go in different direction with the equities. So when equities go up, bonds, they don't go up as much, or they go down. And then when equities go down, bonds go up. But what we've seen since January, that correlation, so negative correlation is turned out positive. So bonds now, there is, and this is because inflation. So again, we have a 2021 situation, 2022, where bonds or equity were correlated positively, and we don't like that. So this is one of the things, that the investment committee is also looking at, and we're on top of it, because that is, then your bonds, you're not getting a great return, right? Because this is sovereign debt. And then if they're correlated with equities, they are not a diversifier, in the portfolios. So they are not doing the job that they should be doing. So, but we're also looking at that as well.
Yeah, and I think it's a really interesting point. And here at Cameron James, our investment philosophy is, effectively buy the world. Don't mess around too much. Have a globally diversified portfolio, but at the same time, we understand for our clients that, you guys watch and read and listen to the news and you understand Trump and things. But I always talk to my clients, and I have to have a conversation about it. But then I always, and I'm sure my team can add the S&P 500 here for a 30, 40 year period on the screen. But when you actually zoom out, and if you were to say to your clients, tell me when Bush was president, tell me when Obama was president, tell me when anyone's president, and actually all you can really spot from the S&P 500 is financial crashes. You can spot COVID. You can spot these things in the chart. Which government was in power or which president was in power. Actually, the long-term trend of the equity markets continues to do their thing. But we do understand. This is very topical, and lots of people want to understand it. Andere, thank you for your analysis this morning. Really valuable. If anyone has any questions on portfolios, if you're a client of Cameron James, you're considering joining Cameron James, you haven't started your journey yet, feel free to reach out and you can have a conversation with myself or Andere or Jonathan or any of our advisors here to understand how we work with our clients and potentially how we can help you. Andere, thank you for joining this morning, and let's see what happens with the Trump bump.
Yes, it's going to be an interesting year, for sure.
Indeed. All right, thank you very much, Andere. And subscribers, as always, take care with your pension assets.